Hello there. Thank you so much for making time and joining us right here on In Focus. My name, as always, is Eugene Anangwa. It's been a very eventful weekend. Of course, we're moving away from the much talked about Miss Rwanda to a very yet important conversation. And of course, I know for sure that either one of you or some of your friends have walked into some of the buildings, the commercial ones that we have here in Kigali, and you might have noticed that there are most of the spaces being unoccupied. Some of them have been unoccupied for quite some time, and so we want to make sense out of this particular issue. What is causing this? Who is the problem? Where is the problem? What sort of solutions can we find out of this? And I want us to be as honest as we can so that we can be able to find a way out of this. Is there any reason to worry for the financial institutions? Do they have any cause for alarm for this particular issue? And of course, our economy at large. We'll be talking a bit about this. The conversation is on the empty spaces in our commercial buildings here in Rwanda. Let me take some time and just go through some of the tweets that have been coming through. I've been asking you if you're a tenant or if you are definitely renting or an agent of any of the commercial buildings in Rwanda. Why do you think we have more empty spaces right there? And some of you have been actually spending your time to actually talk a bit about this particular issue. Isawane, who says that location is the cause of this emptiness. Most of the people are after the visibility of their products. For example, second floor locations are always cheaper, but also harder for retailers to make work as they lose visibility. This is what he thinks is the cause of the reason. And of course, we have Eugene, our namesake here, Lusweti, who says, I'm not a tenant, but why would that be the case when the Rwandan economy is in cheetah mode? About 7% per annum. This is the growth. Maybe with incentives from the space owners, some business people operating in not so good premises can be enticed to move into this particular spaces. This is definitely what we are trying to talk a bit about here. Hassan, a good friend of the show, also says, is it possible for whoever is knowledgeable on the panel to give us a brief on the new property tax? Take us through how much one with more than one property will be obliged to pay. I'm sure this will definitely crop into this conversation tonight. I've seen some people talking about the issue of taxes being one of the reasons as to why the prices are high. We'll understand from our panelists. David Nyonsava says, I got shocked with prices at the new KBC building recently. I wanted to rent a space there, but prices, that's the emoji right, that is right there. I feel like these buildings do not consider the economy of the country or their target clients are not Rwandans. Let's just stick to that, park that for a second and introduce our panelists so that we can be able to make sense out of this particular issue. We have Natalie Rodriguez, who's the MD Forest Jackson Properties Limited, a full-service real estate company here in Rwanda. Thank you for joining us on the program.
Thanks for having me.
Also with us is Fred Mugisha, who is the Director Urban Planning and Construction One-Stop Center at the City of Kigali. Thank you for joining us.
Thanks for having me.
And also with us in the program is now Alexander Semarinyota, Chairman, Association of Real Estate Brokers here in Rwanda. Thank you for joining us on the program.
Thank you for
We are also joined in live by way of phone by Maurice Seretich, who's actually chairperson of the Rwanda Bankers Association. Maurice, thank you so much for making time to join us on this particular program.
Thank you for having me.
Now, so let's just go down memory lane for a minute and talk about 3 years ago. That was about 2016. And there was an opinion piece on the New Times by someone who wanted to voice his opinion. And he titled his piece, A Vote of Confidence in the Economy. The property development boom is a vote of confidence for the Rwandan economy. And what he wanted to insinuate was that the mushrooming of these high-rise buildings that we are seeing today is a sign that actually the economy is actually growing. So I want us to ask ourselves two things from this particular opinion. Starting with you, Natalie, do you agree that the mushrooming of these high-rise buildings is actually synonymous to a growth, a boom in the Rwandan economy or not? Let's make sense out of it.
3 years ago, I can see why that was the opinion. And to some extent, it still is. But my fear is what happens if the bubble bursts. So we're actually in a bubble, especially with commercial real estate at the moment, because I believe in the concept of build and it will happen.
Yeah.
But at what point do you have to pause with that approach to the whole process? We see clients coming into our office now who have taken their pensions to build these buildings, and there's no way of recouping that money. The only thing that's going to happen, the banks are going to take them. The banks are also stuck with these commercial properties. So it's a double-edged sword. Yes, it's a sign of the wealth of the economy, but how do we ensure that it also does not cause the economy to break?
Right. So we're in a bubble. The fear is this bubble could burst. And for how long do we continue constructing this? Let me talk to you a bit about this, Fred, because you sit in one of the institutions that actually is charged with guiding the principles of actually growth and urbanization. And still remaining with that particular same question, the country, can we gauge what we see from the mushrooming of these high-rise buildings to that particular aspect of the growth of the economy or not?
Definitely, yes. On my view and my opinion, I see that this mushrooming of the housing or the commercial building in the sector is actually a sign of the economic growth, in the sense that we as a city or the government, we normally do a kind of study and see what do we need in the future in terms of to have the vibrant economy and diversity of financial resources. Yeah. And if you look at actually the real estate as a sector itself, is actually going to contribute, it contributes more than 60% of the GDP. And if you look at the return, the economy or the sector itself is actually has a lot of rental yield, close to an average of 9%. If you look at the study done in 2016, this rental yield is quite high.
9% is quite high?
I mean, for the startups, exactly. If you look at the market, well, the mushrooming of the existing houses, actually, for me and for the city plan or government plans, is actually a sign of the growth of economy. Right. In the sense that this building, these commercial offices, we have actually the market over there. And the reason, actually, come to your question, the reason why this mushrooming of the building which is empty, it's the actual low occupancy level, is that maybe we can actually look out, do we need this mushrooming building to be constructed in the CBD or in the entire region of the country or entire region of the city? Or do we need to have the study about the purchasing power of the market? Actually, the market is the one that's going to drive us.
We'll be coming back to actually ask you what sort of plans, what of studies you did as a city yourself, because you are the people who are the vision bearers and also the people who drive the city master plan and issues of construction and all that. But before we get back to that, let's bring in Samarinyota as the people who are actually brokering, whether people come in or not, whether someone comes in to construct or not. Talk to me about this, because when 2016, when this particular statement was being made, there was a statement that this particular mushrooming of these buildings was going to actually fill the gap of the low number of supply of quality commercial spaces. Because then people were struggling. We want high quality commercial spaces. So now with these new buildings that are coming up, then we're going to get that we need. But the question is, if that was the problem, then why is it that these commercial spaces that were brought up to fill that gap of the quality commercial spaces are still empty?
Thank you, Mr. Nangwe. I really understand where we are all coming from. At Fishery, at that time, when you're filling an empty space, then somebody will say there is something happening, and you have to appreciate at that time. But at the same time, you have to regret at what rate you are building. And then you have to know whom are you building for. Because if you do not have the equilibrium of demand and supply, then definitely you will end up with the results that we have as of now. Right. Because the supply has been over and above the demand. And we will not go maybe into the economics of factors that determine demand and supply, but it's simple. It's common sense that if you are supplying something that has no demand, then it will be there. And that's what you're seeing now.
So what you're saying is that then, when this was actually this building,
there was a vacuum, yes. There was a gap, yes.
But someone did do proper due diligence.
And at Fishery, you could see that something is happening and something is good. And really many of the buildings were occupied. For example, if you see the Pension Plaza, it's 100% occupied. When you see the Chic building, it's 97% occupied. When you see downtown, although it has its own problems, it's more than 55% occupied. So these are some of the statistics that tell you that there was a need. But how much is that need in terms of demand and supply?
Yeah. All right. Let's bring in
the sustainability of that is important.
the sustainability of that. Before you come in, let's just bring in the finances as well.
Lastly,
yes,
you can look at it as a growing economy, but who is financing that? And what is the cost of who is financing that? And how sustainable is that? And then how is that financing going to actually be plowed back?
Right. Which is important, and the financials are here with us. We have Maurice Teretich, who's just with us listening to this, and I want to read your thoughts, Maurice. As someone who's working with financial institutions, some people have said that this low occupancy rates could force banks to actually apply a cautionary approach when financing any new people who want to get into this particular business. Tell us, or mystify or demystify this particular notion.
Thank you very much, Eugene, and thank you, viewers, for listening to me in this case. Now, first of all, I mean, just a quick reaction to the fairly earlier point about whether construction of residential or commercial buildings is any sign of growth or development. Now, there's a certain anecdote that is generally said that if you want to know whether there's business in any economy, look at the skyline of its cities. The more the cranes that you see, it means there's business to do. Meaning, the more construction you have, there's more business to do. Now we obviously have to take that view in circumspect, because I think the earlier speakers have spoken very well about whether in developing these commercial buildings, there has been a clear and thought out analysis of the kind of product that is being brought to the market and the people that are expected to buy this product. And he said it very well. I mean, the fact that there is a product in the market and no one is buying it, it means that that product is not for the people that currently would be buying. So that raises a very important question about, so then what happens to the commercial banks that are financed these buildings? And it is shared responsibility, because on the one hand, I think in the last probably 5 to 10 years going backwards, commercial banks have been a little bit gung-ho, put it like that, in financing construction in Rwanda, and for good reason. Because as the earlier speaker said, there was a gap, there was a need for funding to develop these commercial buildings. But then, down the road, I think we are now dealing with a question about, is that level of construction that we have witnessed in the last 10 years still sustainable going forward? And my view of it is, there's always a time lag, certainly. And I think this is usually the case when it comes to commercial buildings in any part of the world, that at one point in time, supply somehow seems to exceed demand. And there's got to be a slowdown to allow demand to catch up before the next phase of construction, happens.
Right.
So in that sense, yes, I would expect that commercial banks, in the next 2 to 3 years will be a little bit, cautious in, financing new development, possibly asking the right questions about who these new developments are going to be serving. And I think that question will be allowed louder in the banks.
Right. And so, Maurice, before I let you go, because some people have even pointed a finger, accusing finger at you, the bankers and the people who are financing this, projects, that the interest rates seem to be really high. And so anybody constructing a huge building of about $30 million US would have to repay at very crazy interest rates. And so what do they do so that they can be able to break even real fast? So they have to actually end up putting prices or costs that are very exorbitant and which have sort of scared away tenants. I mean, what would you say about this?
Look, I mean, the issue of interest rates is always very, very emotive in any part of the world, Eugene. Today, America are going upwards. In the last many years, we have seen rates going down. I think that the issue always is interest rates are not created by the banks. It is a market mechanism, which then determines the level of interest rates that are charged by commercial banks, that one makes sure that the owners of the capital in those commercial banks are receiving a decent return. Remember, commercial banks are businesses just like any other. Just like the owner of a commercial building expects a return on his building, so does a bank. The owners of capital in a bank also expect a return. And so, the benchmarking of return on capital, the level of cost for banks to mobilize deposits, which are then, lend out to the owners of the commercial buildings. And let's put it like this, there's also the cost of generating and managing a loan.
Yeah.
Granted, there's still a lot of room for improvement. The more efficient the entire economy becomes, and not just banks, it is the entire economy itself, then we will begin to see efficiencies in cost of managing credit. We'll see efficiencies in terms of how banks mobilize deposits for lending, and that should be able to translate into lower or better interest rates for that matter. But be that as it may, I think the point I want to make, in that respect is that, you see, it is always a question of risk, because when the owner of a commercial building makes a proposal to the bank to say, they want to finance a $30 million, commercial building, and they can only raise, let's say, 30% of the finance that is required, and therefore 70% of the capital required is to be financed through debt. And I put it like this. In reality, that high level of gearing in funding commercial buildings is not great for an economy that is slowly filling in the space that we have, because then it means, a loan is subject to repayment, and whether it is 5 years or 10 years or 20 years, there will be monthly repayments that are expected.
Right.
But you see, if you have a higher level of capital can wait. Capital can wait for greater return when the economy picks up, 10, 15, 20 years today. And I think that's the kind of, discussion that we need to begin having, in terms of the way that we structure financing for some of these probably high value commercial buildings that we are developing in the market. So moving away from heavy reliance on debt, possibly moving closer towards, funding these projects using equity, because equity certainly, can be able to wait out, bad times in the market.
Right. Thank you. So he seems to be washing his hands and saying that we are not to blame at all for this particular issue. And I want to read your thoughts right here, Natalie.
The banks have a role to play. And I think a large part of the problem is the banks have not been doing their due diligence.
Right.
So if I come to you and I say to you, I want to build this building in Kagugu, a commercial space, etc. As long as I have the requisite deposits and everything that the bank normally requires, they're going to say yes. But in a country like this, with there are a number of buildings, the banks need to take it a little bit further and do a feasibility study.
And if they say no, they'll be blamed for not giving credit.
Yes, but then you don't have negatives on your books with properties that can't be rented. So the reality is the banks are to be blamed from the standpoint that they're not doing their own studies and they're granting these loans that people genuinely cannot afford because you cannot rent the building. And you see, when you have a situation where you have these buildings, the landlords will not lower the prices to what the market can afford. No matter how we wish it, people, if you cannot afford to rent a building at $20 per square meters, you cannot. Then your business tanks because you're spending too much. So for me, the landlords and the banks need to get to the point where they say it's better to take something than nothing. In a normal situation, you wouldn't get to that point. But where the situation is now, people have to be willing to take a lower price or they're going to keep sitting on these empty buildings because businesses cannot afford $20 per square meter.
And it speaks of restructuring the way or the models of financing this particular issues.
You have to.
Right. What is your take here?
My take is, here we need to see who is responsible to do what. The government is responsible to do what, the developer is responsible to do what, and the financial institution is responsible to do what.
So in this case, City of Kigali, what is your responsibility? Why do you have empty spaces and what is your responsibility there?
Look, one of the responsibilities is actually to create an environment that is very economic conducive. the city to have its own master plan itself is actually an opportunity for the developers.
Some people have argued that that master plan is part of the problem.
Yes.
That we
I
are
don't
forcing
think so.
these people to construct certain buildings in a certain way, which cannot actually, there's no feasibility study. Where will they get the market to actually get the people who will get into these buildings for them to repay this?
The master plan actually
Actually,
creates something.
If I may add there on that,
Yes. What is their
if the master
responsibility?
plan
Yes.
was not providing a timeline, for example, forcing somebody to close so that they can respect the master plan specifications without providing them a leeway of where to put the product,
Yeah.
that will not be a problem.
Rewind
But we
again,
cannot
come
do
again,
that.
so that you
cannot
don't
do
lose
that.
other
I'm
people.
just
So
saying,
what's the problem with the master plan? Yes.
Let's give an example
Yeah.
of where Akagera was working from.
Yes.
If Akagera now, that area, they're forced to build a 3-story building.
Yes.
Where will they get the market from? Yet, that space was already earning them income.
Yes.
There was no feasibility study done by the city of Kigali, which is supposed to advise, but they stuck to their guns and said, we are supposed to meet these targets
And if you don't, you
at
leave.
the expense
Yeah.
of the business person that is going to invest in that.
Yeah.
Secondly, while they are facilitating minimally to actually have the business person finance, they will not participate that minimally to bail this person out when he is in trouble with the banks. So how do they actually balance the two?
Easier.
Making sure that the master plan is implemented. I respect it.
Yeah.
I believe in it. But it must be implemented in phases, and phases that are actually studied, planned, and guided
By the market.
by the market.
Because it's in your mind that it's going to happen this way, does not mean it's going to happen to this way. So because on this red rug here, you are saying the city will look better with a G+3 building.
Which is okay.
Which is fine. But how are you going to fill that building? And so you have people who are losing their pensions, who are losing their life savings because they're building these buildings and nobody to put in it. But then also, so outside of that, people have to be willing to take less. So some people are building these buildings and expecting to be millionaires after they do so. It is better to take 2 than to have nothing.
Right.
So instead of charging the high rates, take a little bit less. And also, everybody is trying to rent large spaces. Some buildings you go into, even though the building is empty, they say to you, you have to take an entire floor. Suppose a client only wants 50 square meters. Why not break up the building in smaller chunks so that you can facilitate smaller businesses? Because the majority, no, the city is not stopping them, but they are forcing themselves to say, we only want to rent large spaces. Take smaller spaces. For example, the majority of businesses in Rwanda are small. Not even medium size, they're small.
Yes, actually,
so your space,
98% are SMEs and
exactly.
micro.
And as such, you can't tell somebody they must take 150 or 300 square meters when they only need 30.
Right.
But
And there's
then
something. Wait,
don't blame the master plan.
before we.
No, that's not the master plan.
Yes.
That's a landlord's issue.
Yes,
That's
before,
not the master
before we
plan.
move away from letting you off the hook on the issue of the master plan that Semarino actually talks about, I want you to just talk to us a bit about the feasibility study, because that's the worry that most people have. And this implementation of this master plan in phases, which people have been requesting, we need to be given time. We need to know that if we move right now, immediately, we would have this kind of losses. But if you are to let us move in phases, then we should be able to...
Look, Anangwe, the city has its own master plan. It has the master from the citizens.
It's okay.
And having this master plan is great.
Yes.
And we did actually the kind of projections about how many million retail spaces do we need in the entire city to have this vibrant economy as a country. This is what the master plan do to give us a clear direction of where we want to go and what we want to achieve. But it's the responsibility of the client, of the developer, to do his own business plan. He can draw from the master plan actually the true guidelines of what needs to be developed in the entire area. But the city does not actually going to be in your feasibility study of your project to do a business plan to see if your project is going to be feasible.
May I just respond to what you're saying, Fred?
Yes.
I think you're missing the bigger picture here. The bigger picture is the master plan is excellent. There's no doubt. I think it is a beautiful concept. However, the city is not being responsive to the market. So you created this master plan, which says that you must build G+4 or G+3 in this particular plot. But the market is not asking for that. The market is nowhere near that level. But the master plan is not being flexible. And that's what we're talking about. Are you constantly updating the feasibility study so you know what's on the ground?
Yeah.
Exactly.
Additionally,
That's what's needed.
additionally, I was just saying, that building may be necessary.
Right.
Before you build the next 4-level building,
Exactly.
before you force me to close the 1-level building so that the city can look clean and beautiful based on the master plan, why don't you first facilitate the person that actually built the 4 building to have it functional the way it should be?
Right. Fred, could you just respond to this?
Yes.
What is the implementation
Before we can
strategy for
bring
that
back
master
Morris
plan?
on this. Yeah.
Look, our master plan that was under review today is not actually going to be implemented as a whole master. It is implemented in phases. One of the reasons why we're implementing this in phases is actually to see if the short-term phase we want to implement the city master is responding to the realities of the existing contextual realities of the terrain.
But it's not, and we know that.
Exactly. That's where I'm heading now.
Yeah.
Now, if the master plan is short-term, we normally say, well, we need actually like 5 million of commercial spaces over there. But it gives you a clear guideline that within this area, this regional commercial hub, you cannot go beyond the G+11, for example.
Yeah.
And go the further step and say, if of course the market need to drive us, and we really agree that the master plan should follow the market, should follow the demand. And it's up to you as a developer to see, because the master plan has created an environment where you can develop incrementally. This is actually the thing. And where we are actually closing the business is actually, these are dilapidated buildings that needs to be revamped.
Well, why? But guess what happened now? You can't leave it empty.
You
can't leave the land empty.
If you see that you are going to construct G+11 and you don't see any market to fill your G+11, and the master plan does not strictly tell you, please construct G+11, it gives you actually, this is what we need.
Fred, you're not being fair. You're not being outright.
Fair.
No.
Look,
Fred, maybe that's the future.
That's the future.
No. Yeah.
There are times when the master plan says you cannot build below G plus something.
Yeah.
Someone comes and all they want to build is a single-story building,
Yeah.
and the city of Kigali says no, you must do G plus
Whether
something.
you're ready or not.
Whether or not you're ready. That has
So
been
that
the
is not
case.
true, Fred. That is not true.
It is the case.
Look.
No. What I would suggest is,
Yeah.
if I'm supposed to build ground plus 11,
Yeah.
but today I can afford ground,
Yes.
is it possible
it is.
to actually make sure that I build ground? Next year I build the second, the third year.
Maybe there's a problem with disseminating information.
Yeah, maybe that's it.
The occupation permit will only be granted when I have ground plus 11.
Right.
How is the review of the master plan actually facilitating that? Because if that one can be done,
It helps.
then
It will
can
help.
It
Now,
will help.
before you just come to respond to that, I want, first of all, so that we also don't leave Morris out of this particular conversation.
Morris.
Earlier on, Morris, there was some allegation that actually banks are actually deeply intertwined in this particular problem of the empty spaces that we have, because you do not do due diligence. You go ahead, give out these particular loans, which you're not sure that these people will be able to pay. And then after some time, they're not able to pay, and we're seeing these commercial buildings being auctioned and stuff like that. What would you say about this?
So the comment I would make with regards to that, Eugene, is, on the one hand, I think it is not right to say that banks don't do any due diligence. Banks do due diligence, and they do very thorough due diligence. In fact, we get beaten that we are very risk averse. We don't lend money to the banking, to the private sector, because of the kind of things that we observe, or the kind of things that we pick up in our due diligence process. However, banks also, let me put it like this, banks do not have experts in every single business that happens in an economy. Mm-hmm. So banks rely on experts. So, for example, we will rely on experts to tell us what is the market visibility of a particular development that is being done. So what banks will do is we will receive a visibility study from a partner that we call a credible partner. And because it is a credible partner certified by various professional bodies, You know, they have done their due diligence. They've gone out to the market. They've spoken to people who are looking to rent these buildings. They have studied the master plan, and they will say, well, you know, we think that this is a viable project. You know, with the usual things, NPV, IRR, you pay back, and all that and all that. Now, the question that banks will usually ask is, what if it doesn't happen? Mm-hmm. So what is the fallback? And to me, I think that's the kind of due diligence then that banks need to step up a little more to say, you know, what if the occupancy levels do not reach the 70%, where a developer is saying it's going to be the point when they will be able to repay a bank, and it ends up being 30 or 40%. What is the fallback? Mm. Because I think that is where I would say, you know, as banks, we've probably we haven't been as stringent. Let me put it like that. And when I say that, remember, it's a double-edged sword, because the more stringent the banks become, it means the less money is actually being lent into the market. And so we've got to have a balance of life. You know, we can't just say, look, it's too risky, therefore do nothing. At the same time, you know, we can't be, you know, all the way down the ditch without, you know, asking the right questions. And I think that's a point I was trying to make, you know, in that respect. Yeah.
So you usually ask them, what is your fallback plan if this that you're telling us to finance does not work? You do ask them that?
Yeah, we do ask those questions.
All right.
Absolutely. Yeah.
Let's just, yes.
There,
yeah.
Before they make any decision.
Yeah. So in this particular case, what I want us to do is now probably just move this conversation a bit forward, because I want us not to lose track on why we are having these empty spaces. What is contributing to this? Why, and what can we do to actually ensure that these spaces move? In 2017, the city of Kigali did issue a directive requiring all businesses to vacate residential neighborhoods and relocate to commercial zones. More than 910 businesses operating in residential areas were actually mapped across the city, and they had only up to March 2017 to relocate. I want us to demystify the notion that it is these businesses that are operating in residential areas that are actually taking away the business of this commercial buildings. I want you to talk to us a bit about that, because probably this was one of the reasons why the city came up with this directive. Was this the reason? And how do you justify that it is those that are operating in the homes, in the residential areas, that are denying business for the commercial buildings?
Actually, yes, you are talking it. The campaign the city did to have the directive from actually people doing their business in a residential zone that is not complying with the city master plan. It was a part bigger picture of implementing the city master plan. Even though we are actually letting people to construct what is needed in master plan, commercial spaces, commercial retails, at the end of the day, it came to our attention that people are actually hiding in their residential zones, which makes these commercial offices to be empty. So we put a directive from the city level that any businesses that is operating in residential areas should relocate to the complying zone. The complying zone is that those buildings that are already constructed, or any building that was already existence that is in the commercial. I think this was actually one of the responsibility for the city to close the gap of that low level of occupancy in the commercial zones. But well, we have been successful, and I think the bloggers can actually tell. And not only that, and we have even banned that market, I can call it a street market vendors, where we say, you guys, there is no need of actually selling your product on the street. You should actually find a way where you can go to these commercial zones that is already upscaling.
Whether they can afford it or not.
That's what's going to be my question.
Whether they can afford it
they
or
can't
not.
afford it.
Now, when you come to the affordability, this is where they're going to the responsibility of the developer. If the developer is actually not studying the market, the market is, as I said, 98% are micro and SMEs in here in Rwanda. And you are developing, or you are charging actually the rent fees that is attracting high end. And the high end is actually 1%.
It is this SME that is suffering,
No,
because
but
already you've locked
going to be
out
suffering.
my open air market, you've locked it up, and you've forced me to go into this commercial building whose owner or developer is not ready to lower the prices. So in the end, it is my business. I'll close my small
But which
business.
one comes first, the chicken or the eggs? Because I agreed completely. I agree completely that commercial zones are important and that businesses shouldn't be operating at home. You know, I agree with the master plan on that. I think it is great. However, I understand also, Fred, what you're saying, that it's on after you have given the directive, it's up to the developer and the landlords to facilitate persons. But if a landlord borrowed at a high interest rate to build that building,
Yeah.
and they can't, I'm not saying they should charge you 20 because I'm the biggest advocate for lowering prices.
Yeah.
But they sometimes cannot lower to the point of where most of the businesses here can afford to pay the rent.
Yeah. So
and so it's a chicken or egg situation.
What would be the ideal situation?
The ideal situation within the context of Rwanda for me is for one, allow for smaller spaces. That's one thing. So that's on the developer. Allow people to rent smaller spaces in these big buildings. And secondly, on the part of the business owners, be willing to work together.
Exactly.
So let us say you have 150 square meters. How about three businesses that are complementary to each other share the space together? So think more, operating more as a co-working space versus you trying to be by yourself. I think if businesses start thinking that way, it will also help the situation. So let us say I own a real estate company. Somebody who wants a showroom for furniture should partner with me. A travel agency could also partner, and we could coexist in one space together. That's another way for businesses to survive within this market. Start thinking a little bit out the box. And landlords also have to drop the prices.
They have to drop the prices.
They have to.
Alexandra, dropping prices. Is this something that the viewers would be expecting to see happen soon? Is this something that is viable for their businesses and the loans that they are supposed to be paying back? How realistic is this?
Thank you. I think I'll go back to what he said, forcing people that were working in residential areas going to the commercial areas.
Did that work?
Again, I want us to be very careful when we are talking about numbers, because we have to have evidence of that. Let me just explain. If I've been renting a house of 400 square meters space, I'm paying $1,500
dollars.
If I go to this commercial building and I need 400 square meters, I'll need to pay $8,000 minimum. So what option do I have? Close, go home, or relocate. And that's what actually has happened to many. Many have closed.
They closed businesses. They did
many
not
have
move
reduced
to commercial buildings.
their spaces. And when you reduce your space that you're operating in, that means the quality of service that you're offering and the expectations from your clients are dropped. And people, you act small. Again, getting to what you had just asked about dropping prices. Maurice just said it. We know it, that the financing of businesses is too high.
Way too high.
The developers have no option if they are to pay the mortgages within the stipulated period. So rates can only be developed or dropped if there is external financing coming in, if the capital markets are very well developed, and we have not the banks only financing, but we are attracting investors coming in, not expecting quick returns on investment. That one is possible because then the investors or developers can access this money at a low rate. And if you observe, we have some people that are actually getting their financing from outside at very low rates, and you find them their rates are very low. We don't have, again, data. Statistics are nowhere to actually guide everybody on this. And I'm insisting that as partners in all this, if we really want to help each other, the city of Kigali in planning, you cannot plan, if you don't count, I used to have a friend, if you don't count in terms of numbers, you don't really count in terms of relevance. So we need to focus on how we can have data. And who are the people to give the data? The agents.
The agents.
But are they organized? No. So we need to regulate these agents so that they can actually give us the data, daily data on everything.
So need daily data.
And this daily data would actually facilitate the city of Kigali or any other planner to actually facilitate developers to be able to know, whom am I building for? What is his capacity to afford? How long, if I put a building of, say, $30 on the market in the Nyarujenje sector, how long will it be on the market? Because the statistics will show. The trends will show. So the data analytics will show that. Really, if we move away from that and we address the issue of the financing of business, the cost of financing of business, be it in the cost of materials, be it in labor, be it in interest rates, then we'll have partially addressed the issue and facilitated the possibility of reducing the rates.
But in addition, quickly, Eugene, in addition to what Alex is saying, because I agree with him completely, is also the matter, because back in the day here in Rwanda, when you built a commercial building, you could become extremely wealthy off of it, because there were few buildings. And so people now have not recognized you can't make that money from commercial real estate in Kigali anymore, but they're still trying to. So for example, I've been with landlords who say, I said, well, how did you come up with this rent? They said to me, I know how much money I want to make, and then they work backwards. So they're not responding to what the market can afford. It's what they want to make. So people have to stop. So we can lower the prices by landlords and developers lowering how much they expect to make.
Lower your expectations.
Lower your expectations.
But before we get to that, let me just quickly run and read the tweets. But I want to hear from you, Fred. What data are you using? Because Semarinyota actually says it really nicely here, that we need to have our decisions informed by data, by statistics, by numbers. You earlier on alluded to the fact that the agents can tell us that actually the closing of these businesses that are operating in commercial, in residential areas really did help to actually push them to these commercial buildings. What data are you using to say that?
Well, actually, I agree that we should be data-driven. And of course, if you are preparing in a planning agenda, you should actually depend on the data. Either socio-economic data or demographic data, and exactly and what you are forecasting in a couple of 10 years to come. But right now, what I can actually tell you is, well, for the data we used to have in 2013, that actually helps us to prepare the entire city master plan and the number of commercial spaces do we need in a couple of 40 years time to come. We normally depend on the statistics, the existing statistics, the national data, and the social demographic data we need.
But the data on sales and rental is not collected anywhere now.
Yes, and that's why within a couple of 5 years while implementing it, we came to attention that we need to do a kind of a comprehensive commercial real estate analysis. This is actually the study that is underway, and we have actually the preliminary kind of draft, and at the end of April, I think we are going to have a clear analysis with the commercial area and what do we need. We're not doing this study for the purpose of seeing what's the occupancy level right now. We want actually to have this study as a guiding tool to the developers to see, even though you want to do this, but this is actually the data. This is the data can tell you if a business is going to be feasible or not.
Right. Okay. But let's bring in again Maurice before we read the tweets that we're having here. Maurice, the cost of, the money that we borrow from your institutions is still too high, really partly to blame for this. What sort of way forward are you offering, probably before I let you go, to the people watching us right now, and they are in this business of this big real estate projects? What sort of hope is there for them as far as the cost of the money?
So, two things from me, Eugene. One, I think, first of all, I would just like to demystify two notions of financing in commercial banking. One is, when it comes to, there's a very big difference between cash flow and cost. Now, what pays loans is cash flow, okay? And I think what we are talking about today in this show is an issue of cash flow rather than cost, if you ask me. Because the fact that a landlord does not have tenants in his building means they don't have cash flow, which means that even if you reduce interest rates to the lowest level, they still don't have cash flow, so they will not pay, okay? So it's very important to make a distinction between cash flow and cost. Yes, cost is the interest rate that banks charge. First of all, let's also remember that the longer the loan repayment period, which is what I have heard many times people say, banks finance in the short term. The longer the repayment period, the higher the interest cost. Because what it means is that the customer is actually paying interest over a much longer period of time, as opposed to when a customer, is willing to pay within a shorter period of time. But to be able to pay within a shorter period of time, you have to have cash flow. Now, obviously, and the point here is, and I had a comment about financing from outside of Rwanda. And I said, we've got to be very careful also about that, because put it like this: if you borrow dollars from America today, and you get LIBOR plus 6%, which is usually the sort of interest rate that you get, we're actually talking about 8.5%, maybe 9% today. Now add a 5% annual depreciation of the Rwanda franc. So you're talking already about 13% in dollars, with no control about what happens to the exchange rate between the Rwanda franc and the US dollar.
Right.
Now, so it's also very good to be careful about that. But then the second point is the Rwanda franc today is yielding about 16% in terms of average lending rate, for most banks, 16, maybe 17%. Now, the one thing that a lot of people do not appreciate about interest rates in Rwanda is that they are very stable. I have seen interest rates over the last 10 years move only by 200 basis points up or down. And now, which means they can be priced into the product,
right,
if the product is right.
Right. And so I want to understand from you, probably, Maurice, because of time. Thank you, I appreciate you.
Yes.
But just because of time, just probably one line. What's the commitment of the bankers then, financial institutions, where you sit? What is your commitment in actually salvaging this situation that we're in right now?
Look, Eugene, I think that is not a straightforward question. I wish I would say banks will lower interest rates, but on the basis of what? That's my question. You see, the point is, banks have a cost of mobilizing funds. And today, when you look at the cost of mobilizing funds and the opportunity cost, and the question is this: a shareholder has $10 million to invest in Rwanda today. Investors are rational, including those that invest in a bank. They are rational people. So they will say, look, if I'm not getting a return less than a long-term government of Rwanda bond in Rwanda, which today is 12%, what is the point of taking credit risk and getting 13 or 14%? There's no point. I think that is finance.
Right.
And I think we need to be realistic about it. Our market cannot afford local currency interest rates today at 6 or 7%. The economy needs to grow. The economy needs to create wealth. The local citizens need to save. Pension funds need to save. In the long run. And it's
a long run. Right. It's a long
term thing.
So in other words, what you're saying, your hands are tied, and so there's nothing much you can actually commit to this. I think so. Just yes or no. Yes.
Look, Eugene, I think banks try as much as possible to cut cost of operations. And I think
what can they do, Semarinyota?
If really they reduce the risk in terms of doing perfect valuations, and that is today the valuations are not yet very perfect, and therefore the risks are very high, and that risk is transferred in the high interest rates and is transferred further to the consumer because he's the one that eventually pays. So I believe there is an initiative that is ongoing with, I think, Informatics Africa and the Valuers Association, the Institute of Valuers, to start online valuations that are almost 99 risk free. I believe if they can work so that that one is done, then one, the non-performing rates may be reduced, and the reduction of non-performing rates may reduce the risk, and with the reduced risk, maybe, I already stand here to be corrected, maybe then the interest rates may be reduced, and that may salvage somehow
the cost of these particular spaces. I don't know if you want to take that as your closing remark, because we need also to know the way forward. Where do we go from now?
Way forward?
Yes.
That one is that.
Yes.
We have to keep looking at the possibility of attracting more investors and more capital flow, and therefore looking at our capital markets and developing them further so that we can have more free financing that is not necessarily mobilized by the banks. Two, we have to support asset-backed equity, which His Excellency is doing. We have to support him. Finally, we have to deal with data. I'll say data, and then share it and share market information so that we act as partners. And whatever decision we make has to be informed I beg to disagree, so that we do not act within compartments, but we open. Get out of the box and work together.
That right. Fred, moving forward, do you think it's time to halt the construction of more commercial buildings so that these ones that exist are occupied and serve the purpose? What do we do? What do we do moving forward now?
I think, yes, we are actually looking at how it can be data-driven to see what the data do we have right now, and to see how can we advise the next step.
Reliable.
And reliable that, of course. And another thing we are doing, actually, the government side, we are actually putting some strategies. How can we have this flexible zoning? The people are crying about the city master that they have rigid zone that cannot be changed. But now, within this review of the city master plan, we are doing actually how you can have the flexible zoning. How can you disseminate information? That is the thing I already talked about, and we said you are not agree with that. How can we have an incremental housing so that people can actually plan G+11, but at the end of the day, due to the market forces, they can construct G+1,
right,
depending on the market.
So the promise you're making for the people watching, as far as the city of Kigali is concerned, on this major issue is what?
Sorry?
What are you promising? What are you committing to?
We are committing to actually have this building to be occupied, and to be having the data, reliable data. 3 is actually, we are recommending actually people to put the resources together.
Consolidate.
Consolidate. Right. Otherwise, we cannot actually implement what the city needs. And we all agree that we need
with another real estate company to consolidate. Is
Absolutely.
This viable? Yeah.
Absolutely. And then you can't survive. You cannot survive as a small business owner in this city unless you're willing to work with others. Right. So as I mentioned before, businesses have to play their part. Get together and share office spaces is one of the suggestions I would make. For the banks, I think there has to be a way. I know it just doesn't happen miraculously, and banks can't just get up today and say, I'm going to lower the interest rates. But there needs to be some thought on that. Also, more feasibility studies, and landlords and developers needs to let go of the mentality of choosing how much they want to make first and then working backwards.
Right. Thank you. Thank you so much for making time for that. Just real quick, how in Rwanda financial institutions need to do more analysis before giving loans. Risk analysis, check the viability of the business plans of any new building, do their job indeed. Emil Gustav says it's simple. 1, the market is too young. 2, landlords want to return on investment in a short time. People are not willing to climb stairs to shop for upper floors, and City of Kigali should not slow down the developers to maintain. Thank you so much. There's lots and lots of those particular tweets that have come through. I want us to keep that conversation going on. City of Kigali, that is their Twitter handle, and of course my guests here are also on social media. Just tag them. Let's keep this conversation going on. Even if it ends here on these 4 walls, it has to continue on our social media platforms. And I'm also hoping that my predecessor soon will be able, rather my successor soon, will be able to carry these kind of conversations on and on. And I want to say thank you for being a part of all the In Focus that we've been done right here on this particular television. My name, as always, is Eugene Anangwe, signing off.